you're allowed 45 days after the date of closing. So the day you close on your sale, that's day zero for computing the 45-day identification period, as well as the 180-day exchange clock. And those clocks are running concurrently. So you could fly by the seat of your pants for 45 days and try to figure out what you're going to identify. Now, from a stress perspective, it would have been a lot easier if we would have locked up a purchase agreement early, maybe even before you closed, so you knew you had a sure thing. But many investors are going to use that 45-day period to scour, find what they want to identify. Sometimes they get it under contract before they identify. Sometimes they identify multiple properties and then try to get it under contract after the fact.
Is it contract or close?
Well, you have to close within 180 days.
Okay.
You do not have to have it under contract to identify it, but it might be prudent to try to do so because you don't want to waste an identification and then find out that the property sold to someone else, was sold out from underneath you. In a hot seller's market, sometimes you have to be proactive.
I would, as an agent, I'd definitely recommend being highly proactive because you could have a big tax bill if you're not able to execute this in a timely fashion. And in a capitalist market, you need that capital to function. Basically, I mean that's what you're trying to grow on top of. So you'd hate to see a quarter of that disappear,
or a third of it, or even more. People that are selling properties in California might have an effective tax rate of like 50% between the federal and the state. Crazy.
Insane.
And so what if the reverse happened where, for whatever reason, the property you were going to sell got delayed, but you had to perform on the property you were going to buy?